Citizens of the world, welcome back to another Keep Yours podcast where we try and keep a few more dollars in your wallet. This week's episode is on life insurance and quite possibly the worst possible life insurance policy that you could ever buy, which has angered me to the extent that I'm probably going to go off on a good rant here later. But before we get into life insurance, first off, note that as I put up our survival guide to finding freedom in capitalism, I've kind of crossed out capitalism now because, well, with all the government intervention and how ruined and crooked our politics are, I'm pretty sure we don't have much of a free market left anywhere. It's all been intervened upon by those who have power and are in control. And you need look no further than the billions of dollars it costs you to get elected and the amount of control that our government has over us as they continue to take away more and more of our liberties as everyone pursues the idea that government's going to take care of us. Anyway, so it's whatever this is at this point. I don't know. We're just trying to survive in it. So, follow up on some of our data from previously. So last week or a couple weeks ago, our last podcast was on inflation. And it just so happened that this week, hey, here you go. Here's the article. Inflation's already here for the stuff that you actually want to buy. So if you listen to that podcast, then maybe you're the one in a million now. Maybe you're the one of the 300 people in the U.S. who completely understands inflation, because I sure don't completely understand it. Now, I do understand the inflation part that I discussed, which is when they print more money, there's an inflation in the amount of money. That just is what it is. But when we actually see price inflation, that's the tricky part. So, of course, we're seeing it, and this is what this article was about. We're seeing it in the places where we all want to buy goods. So the things that we all want right now, that's where inflation happens. And that makes sense. At the beginning, it's going to be focused in the areas of which we're all trying to buy the things that we want, as in toilet paper inflation when crisis hits. And so we've definitely seen it in food, and we'll start seeing it in other things. Now, over the short term, and by that I mean the next couple of years, and possibly only a year, but in the short term, I expect there to be deflation because people will not be buying things because people are unemployed. And that leads us to another thing that we've continued to discuss, unemployment claims. And here's last week. This is September. 900,000 new unemployment claims. Okay, for historical context, and realize we're 6 months into this new COVID crisis, right? Historical context from the Federal Reserve, here's claims. Prior to 2020, this week would have been the highest week of claims ever, except for this whole year since March, we've had the highest claims ever, every single week, surging to 7 million in 1 week. Back in, I think that was April. Might have been March even. But that just tells you how horrible the market is right now, how bad it's going to be. So a couple podcasts ago, I said this is the beginning of the depression. This is the data that supports that. You can't continue to have new unemployment claims, not number of people on unemployment, new unemployment claims at the highest recorded rate ever, week after week after week. Take out 2020, and this week would be the highest week ever. This would have been a colossus. This is way worse than 2008. Look at the data from back then. These numbers were not that high, okay? Not 900,000 per week. We've never seen these kind of numbers before, and these are ongoing numbers. Crazy. All right. So that's just supporting prior to what we've talked about. Know that that's still the case. And let's get on to life insurance. All right, so as we get into life insurance, let's talk about why we need life insurance. What is life insurance for? And life insurance is a financial tool. And make no mistake, when you buy a life insurance policy, you are praying, realistically, that it never, ever, ever gets used for you. Because most policies, to be affordable, are for a set amount of time. This is what's known as term life insurance. This means that an insurance company is going to say, hey, I'm going to take everyone that's age 40 to 65, and we're going to allow a 40-year-old to buy a policy up to 25 years, right? And we're going to set that at a low price such that if you die, you're the one of the percentages that die. This is how insurance is supposed to work, right? We all put money in. For the people that die, it pays out. For everybody else, that's what you paid in for. In case you were the one that died, your family got paid out. It's a pretty simple concept. This is how overall insurance works. When we pay in for car insurance, all of our money goes into the insurance company. There are a certain amount of accidents per year. The insurance companies pay out that money, and they're left with a little bit that's their profit for handling all those transactions for us, figuring all that out. Life insurance is supposed to work the same way. So the idea is that you're never going to want to need to actually get paid on the life insurance. That means that you're dead or somebody that you love is dead. So life insurance is basically to protect your family from catastrophe, okay? And it is a tool to help replace the lost income from your demise that is required for your dependents, all right? So if you don't have dependents, right, if you don't have people who are dependent upon your income for their food and shelter, right, then having life insurance makes you worth more dead than alive. Let me say that again. If you do not have dependents, and even if you do have dependents, life insurance could make you worth more dead than alive. You can buy more life insurance than your expected earnings for the next 20, 30 years. Right? You can buy that much life insurance. But all that does is give everybody who's the beneficiary of that policy an incentive to kill you. And that's not something you typically want to do while you're alive, is give people incentives to kill you. Okay, so we don't really want life insurance. We all hope life insurance doesn't pay off. So why do we buy life insurance? To protect those who are dependent upon us, lest they become destitute, okay? Or to try and help the burden that's going to be placed on your family if you die and your income goes away. Now, depending on how dependent your family is on your income, that depends on how much life insurance you would calculate that you needed. So typically the only people that need term life insurance, outside of the business proposition where banks want life insurance to be protected for their loans, is parents and small policies for spouses. Okay, depending on the amount of dependency you have and depending on where you're at in life. And so the amount of insurance you're going to need depends on the number of children you have and the age of those children. And let me explain the age of those children and how that's important really quick. So if you just had a brand new baby and it's 6 months old, well, you have 18 years of needing to pay for expenses for that child for food and shelter. Now, if the child is 16, then you have 2 years left. Now, maybe you want to include college. So maybe you want to say, okay, for a newborn, we're going to run that to 22 or 23. And for my 16-year-old, maybe it's 6 or 7 years. Fine. But you have a time period of which there is a dependency on you. And after that period, you're hoping that you've raised your children and they can go off and be on their own. So how much insurance you need depends on where your children are at in life, and also how much a family can afford and what's reasonable. So the point of this is to show that insurance is specifically, life insurance is not for children. You don't want to buy a life insurance policy on a child because then you get paid if your child dies. Well, why do you need money if your child dies? With the exception of you could say, okay, well, maybe I would like some money for funeral costs and for the mourning period. This is not something that you make a conscious financial choice in to get paid if your child dies. And also, before we talk about that, we're going to talk about what's the likelihood that you're going to die, right? What does the actuarial life table of life expectancy say? And don't take it from me. This is from the Social Security Administration. This is your probability of death, your likelihood of dying. You see these? Oh. Yeah, that means very, very, very unlikely. Looks like the lowest age at which you're expected to die would be 10 years old. And it's so low here. I mean, 0.000097%. Okay, so the probability of a child dying, if you add all of these up from 1 to 2 all the way up, you're still not getting to even a 1% chance of dying. Now, as you get into teens, it's interesting that didn't PDF very well with the titles over the top of the next column, but as you get into late teens and early 20s, the probability goes up a little bit because of irrational behavior and also suicide, which is a problem. And by the way, life insurance does not pay out for suicide. So I show this because I want you to know that the probability of a child dying is so minuscule that there would be no real reason to insure your child. Children don't typically die. If they do, it's a tragic accident, not something that you would think that you needed to have insurance on. So again, what's life insurance for? It's for dependents, right? Not for parents, dependents. It's for your children to make sure that they maintain a standard of living if you die because you can't work anymore to create the income that would pay for them to survive. All right. So life insurance needs change as the family situation changes, because when we talk about insurance, we can go, okay, well, I'm replacing income, but we also then, as we get older, we have more assets in life because we have retirement assets or we have homes that we've bought. So as the situation personally changes, let me just describe it so I wrote in here that small policies for spouses. So, and we're going to get into my specific situation, but let's assume that I died and I'm the majority income for our household. Well, I wouldn't want my wife to be destitute, but at the same time, she could go out and get a job and support herself. She's done it before. She could do that again. Now, I would want her to be taken care of, and I wouldn't want her to have to fire sale the house because she can't make home payments, right? So the amount of insurance I need, though, depends on a lot of things. If we have more in savings, then all those payments can be made. She doesn't need the extra money, right? And she wouldn't need the big house that we have if I died, so she could sell that house and take the income. But you don't want to fire sale it, so you want to make sure that there's enough to cover some payments for a while so you can sell it in an orderly fashion. Maybe that means some work needs to be get done, or maybe you have to wait till the spring when homes typically sell. These are different kind of things that you need to think about when you're talking about how much policy do I need. Now, as we get older and we have retirement accounts that have grown and there's more equity in the house and we have a home equity line of credit and we have just different credit between us that is available, the necessity of a big life insurance policy continues to go down. And this is why typically term policies are written for like a 5, 10, 15, 20-year period, because as those periods change, so do your life insurance needs, and you don't want to keep paying for more life insurance than you need because, once again, you're giving people an incentive to kill you, and that is not something that you want to do, right? So, as the family situation changes, insurance amounts change. Children get older, the need for as much coverage reduces, right? And remember that the idea here is you're putting into this pool for life insurance, hoping that you never need it. So as soon as you don't need to be in this pool, you don't want to give them their money. You want to keep that. That's family money. So we're taking a small percentage of family assets, and in the event of a catastrophe, the family is covered. This is what insurance is, okay? Especially life insurance. Life insurance is, let's pay a little bit into this big pot such that if somebody who everyone else is responsible for their income dies, they're not destitute. That's the idea. But you don't want to give any more into that system than you need to, because not only are you incentivizing your death, but you're giving away family money. You have to pay for these premiums, right? And now insurance companies want to sell you a slew of products. And we're going to get into that. Most of them are nonsense. And all I'm going to tell you about is the only coverage that you need for life insurance ever, unless you're really rich. And if you're doing that, then you've got other advisors. You're not listening to me, because I am not a financial advisor. I'm a financial educator. Right? This is not financial advice on what you need to do. This is financial education on what you need to look at and what you need to understand before you make your financial decisions. So let's make sure that's very clear. All right. As your children get older, as we discussed, reduce that coverage, right? A 16-year-old does not require as much coverage as a 3-year-old, right? And that doesn't mean that the family can afford, $1 million of coverage when the child's 3 down to $50,000 of coverage when the child's 22. It doesn't need to fluctuate year over year that much. It just needs to be understood that these things change over time. And so your needs change. And you need to think about that when you're getting into a policy and for how long the policy will last. As a family's assets increase, less insurance is needed, such that when your child's young, you may need more insurance. By the time they get to be a teenager, you might have enough in your retirement account such that if you die, they're okay. In which case you don't need life insurance anymore. You already have the insurance for them. It's called a bank account, right? You won't see wealthy people who are born into wealthy families. They're not going to put big life insurance policies on themselves because if they die, their kids already have a bank account. They have money. The family has money. So we're not going to give our money to the insurance company if there's an accident. It's for the rest of us life insurance is really a middle class product, right? Because if you're poor and can barely pay the bills, then you don't have extra money for insurance, right? Now, sometimes those are the families that might need it the most, but they can't afford it. So if you can't afford it, you're not in the game, right? But if you can afford some of it, then you go, how much do I want to afford? How much money do I want to throw into this pool? Yes, if I die, my kids will be more taken care of if I throw more money in this pool, but the more money I throw in the pool, the less money I have to take care of my kids today. So this is the offset. This is the trade-off of, hey, let me take a little tiny piece and put that away just in case that I die, right? Because again, that's not the outcome that we all seek. So let's not make a gamble on what we don't want to have happen, right? However, it's smart to protect your children when you can use a small amount of your income to go into a big pool of protection. And that's what term life insurance is, a big pool of protection where everybody of that age puts in a little bit for a decent amount of coverage. And realistically, it shouldn't be that expensive until you get into crazy high policies. And again, what's the need for that? Who has that much expense that they need to cover? Not very many people. Usually the high policy amounts are left to businesses. All right, so here's your life insurance situations. Let's say you're single and you have no kids. You have no reason for insurance. Who are you insuring against? If you die, what happens? Who's dependent upon you for income? Okay? Now, if you're single, you have no kids, but you have a parent who is dependent upon you and part of your income for taking care of them, now you have a dependent. So typically kids will be the dependent, but parents could also be a dependent. So let's say you're 35, you've got a 70-year-old mother, your father's passed away, you help take care of your mother without you paying some of her bills, her standard of living would go down. You might put an insurance policy on yourself with your mother as the beneficiary. That's a potential other situation that you might look into. But for the most part, again, you become worth more dead than alive, and that's not a situation you want to be in. All right, now let's change this and say you're a single parent who has a kid. So if you're looking at a policy, it would be a term policy to cover the child's expenses should they have to go live with another family member. Because if you're a single parent, I'm assuming that the other parent's not involved. Now, maybe they would be. And then you would go, okay, well, how much could they provide? Maybe you have split custody and it's 50-50, in which case your insurance policy would really only need to cover half of you. But if you wanted to cover what are the expenses if they got to go live with a family member? Well, maybe the family member you want them to go live with is got a 1-bedroom apartment. Well, now with a child, they'll need a 2-bedroom apartment. So we need the extra expense for the extra bedroom, the extra food, maybe daycare, depending on the age of the child, all sorts of small things that may come in. But overall, that's a big picture kind of, there's real things there that need to be covered. And while your family member may or may not be able to do that on their own, the idea with life insurance is you're helping them out. The idea is you're saying, I'm gone to help. Here's a policy that I got. This policy is going to help you out where I would have. That's the idea of life insurance. All right, so once the child is older, you don't need that insurance anymore. So again, that's family money that's going out right now into this pool. But when your risk goes away, you could almost think of life insurance as like part of a journey. Okay. And on part of this journey, you're going to be walking along a cliff. And if you fall off the cliff, then you die. Okay. So before the cliff, it's on a hill where if you fall down, you just get a little dirty, you get up, dust yourself off, no big deal. Then you have the part where we go over the cliff. So the part where we're on the cliff, if you fall off the cliff, problem. Right? Once you get past the cliff, i.e. once your children are 22, now you're back to falling down in the dirt again, no big deal. Then you don't need the insurance anymore. So you only need the insurance for the time when you're walking on the hike of the cliff. That's an easy way to think about it. So if you're a single parent and you're on that cliff and you go, hey, I want to make sure that the people that are left behind get past the cliff, right? Well, they only need insurance to get past the cliff. Once they're past there, they need to be able to take care of themselves, which they're going to have to one day anyway. So if this is you, you're the single parent, you would buy a term policy that would end when your child typically turns 18. Maybe you want to run that to 22. You figure out exactly what you want that to be. So the next situation, now you're married, but you have no kids. So the amount of insurance you would want would depend on household assets and the amount of income provided by each person. So let's say that it's a 50-50 household and each person makes $50,000 a year for household income of $100,000. And you use each other's income to, you need both incomes to pay the mortgage, pay the car payments, pay the insurance, pay for all the things, right? Well, now if one spouse dies, you don't have all the same expenses because you won't need two cars. You won't need to pay insurance for two cars. You won't be paying for food for two people. It'll be one. But you also have a person who potentially needs to take some time off because they're mourning. They need some time to sell a house, potentially, so they can find accommodation for one instead of for two, or at least reduce those expenses or get a roommate or figure out the situation. So you might say, okay, well, what happens if one of us dies? What are the expenses that we have? And let's get policies on each other to cover the difference. Now, what if one person makes 80% of the income and the other one 20%? Well, now you wouldn't want the same policies. So let's say you go, oh, right, well, if one of us dies and we're at 50-50, $100,000 of coverage would be plenty, right? For a $100,000 policy, it's going to be pretty cheap. Now you go, okay, well, how do we do that? Well, if each of us are 50% of the income, then each of us would have a $50,000 policy, or each of us might have a $100,000 policy, right? If we decide that's what would be needed. Now, what if one person is 80% of the income and one person is 20%? And in total, you've got $200,000 in policies on each in total, right? But if one person's 80%, then one person might have a policy for $150,000, and the spouse that only makes 20% of income might have a policy for $50,000. Such that, think of paying the bills. How does the family continue to pay the bills is the right way to think about what kind of life insurance that you actually need. So that if one person makes 80% of the income, i.e. pays 80% of the mortgage, 80% of the car payment, 80% of food, 80% of insurance, you need that 80% covered. So in that case, it would disproportionately go to the person who makes more income. Male or female, doesn't matter. Could be the wife, could have a stay-at-home husband, or it could be reversed, right? So that's how you break that up. So term policies, and they typically to cover expenses for a short period, right? So I'm not talking about the term policy when I'm saying 1 to 3 years. I'm talking about the expenses. So you would want a policy that would cover the expenses for 1 to 3 years, right? That's the furthest I would go. Otherwise, you're back to being worth more dead than you are alive situation. And it's super easy to overinsure, right? Absolutely. They'll sell you more policy than you need every single time, just like they will sell you with anything else. You can get a bigger car than you need. You can get a bigger house than you need. You can get more life insurance than you need. And then you, again, are just paying more money into the pool, have less money for yourselves, right? Which is antithetical to my whole policy of keep yours. right? Get what you need, not what you don't. So we got to understand it. All right, now we're married with kids. This is when it gets trickier, right? So your term policies are to cover different potential situations, right? Again, if one person is providing the majority of the income, the weight of the policies needs to go. But let's say you've got a family with 3 kids where the mom stays home all the time, takes care of the kids, and the dad goes out and makes all the money. We'll call that traditional family. But let's even flip it, just for fun. So let's say the mom's a lawyer or about to be a Supreme Court justice, and dad has to stay home and take care of the kids, even though he used to be a federal prosecutor. So we can bring this into a realistic situation we're talking about this week with Supreme Court justice nominee and go, what if you're that family? 7 kids at home, okay? And the wife is the primary breadwinner, about to be sitting on the Supreme Court, about to be pretty busy, right? So now dad's the caretaker. So a simple situation discussion would be that, hey, well, mom makes all the money, so we don't need a policy on dad. Except for, what if dad dies? Mom still has to go to work, right? Who's taking care of the kids? So in a family situation, you got to think about not just the revenue stream that's lost, but the work stream that is potentially lost as well. So if dad's at home taking care of 7 kids and he dies, well, now you need you need that someone to take care of those kids, right? And the idea that you're just going to find a new dad who's willing to walk in and take care of 7 kids that aren't his, while I've seen that happen the other way around, it just seems unlikely, and it's not the way you would want to plan for something. So my point is you don't want no policy on dad in this situation, right? You go, okay, well, what are the ages of the kids, right? How much could the kids help out with that situation if dad were to die? Or how many of the young kids do you have that would require daycare, for example? And you go, okay, well, what amount seems reasonable, right? Maybe that's a $200,000 policy on dad, but meanwhile, mom's the breadwinner for 7 kids, and if she dies, then yeah, maybe dad goes back to work, but in the meantime, so you might need $1 million policy on mom and a couple $100,000 on dad, and that's how you decide to break it up. And again, you can always buy more, and typically with most families, you're going to buy a little bit less than you would like, just because that's a financial reality of we don't want to give all of our money into here. We're going to give our money into this big pool. Well, that's less money that we have today to spend. So insurance is this tool that you want to have a little bit of, but not really too much. Never too much. Too much is you're worth more dead than alive. So typically these term policies would also end again at children turn 18 or 22, and then you might revert to the married no kids situation, right? But remember again that I talk about the amount needed changes as the circumstance changes. So married no kids, when you're early on and have just bought a house and don't have a lot in assets, that's different than married, you're 55, there's retirement accounts on both sides, there's great appreciation in the house, you have a savings account that's covering 6 to 12 months of expenses. If you're in that situation, you probably need no life insurance because there's enough covered such that if one spouse dies, the other spouse gets their retirement account. That's probably enough to cover them right now. Plus, all of a sudden, the expenses go down a lot. The house might be paid for. Depending on your circumstances, and the more assets that a family has, the less you need the insurance because the more coverage you already have. It's called your assets, right? That's the coverage that the wealthy families start with to begin with. If mom or dad dies, there's already money there, right? That's a nice luxury. Right? For those in the middle class, this is the luxury you're trying to pass on to your children, is just in case I die, hey, wait a minute, I've spent some of our money and it needs to be a small percentage, for insurance. This is the whole point of insurance. So this is the game that we're playing. And I just want to make sure everyone understands the game. And the game is how much money do we have to put up to cover our kids in case of catastrophe, and realize that for the most part, you want none of these policies to ever pay out. That means that somebody that you love has died. So keep that in mind. All right. So that's how life insurance works, and those are your situations. Only buy term life policies, right? People are going to try and sell you whole life, right? Which is, there's the cash out this and all these other benefits. But here's what that is. That is turning your insurance company into your investment company as well. And why are you going to commingle the two? Keep them separate. Term life, use it as a tool, right? To protect your family. That's it. Do not turn that policy into, oh, it's also my investment, because it comes with a lot of strings attached and a lot of fine print that you don't want to get into. And a lot of people are losing those policies right now because in that fine print, it says if the insurance company doesn't get the returns that they expect, then your rates go up, i.e. you have to pay more for the same coverage that you thought you had. And guess what? Rates go up. Now you can't afford the rate because you're on fixed income when you're retired, and the policy lapses and your family ends up with zero, right? Or you're cashing out later. Just trust me that it's not a good deal. It just makes it very, very, very messy. And there's no reason to do that. Keep your investments on one side. Keep your insurance separated on the other. Use a hammer to hit nails, not to fix your drywall, okay? And that's the way you want to think about insurance. It's a tool, not a hammer that fixes everything, okay? So here's the shame on Gerber Life Insurance. And once in a while, I get things in the mail, these kind of advertising things, and I go, this should not even be legal. The amount of theft that is going on here is absolutely ridiculous, and this should be illegal. You're stealing from people, and Gerber Life Insurance is stealing from families. Stealing from them. And this makes me very, very, very angry because they do it in very manipulative ways where they're selling it as though you're protecting a child. You're doing your child a favor. And the fact that they would send these out to grandparents and to parents, heaven forbid you got a new mom, just came home with a baby, and here comes the mail that says, oh, protect your new baby because they need protection. Your baby does not need life insurance. You are not dependent upon your child for income if the child dies. That is ridiculous to begin with. Now, the other thing that's really irritating to me, I mean, it's kind of hilarious because I assume it costs money. I know it costs money to send these things out, and Gerber's paying for my information from somebody, but I don't have kids. I don't have grandkids because I don't have kids, but they're sending one to me. So that in and of itself is hilarious to me, but let's go through why they're crooks, okay? And this is a copy of the letter that we actually got. And I scratched my address off, but this was sent to my Denver address, right? And here's where it starts with. This certifies that the child or grandchild of me may apply for grown-up plan whole life insurance from Gerber Life. As though you need a certificate to apply. Okay, let me tell you who's ineligible to apply, because this implies that you need eligibility to apply. Who's not qualified to apply? If you go on Gerber's website, everybody's eligible to apply. So why do I need this certificate, Gerber? Oh, I don't, right? And this is imagine if this ad got sent out. So this certifies that David Bradshaw may pay for life insurance such that if his child dies, he gets money. Put that on there. Be honest about it. And I challenge this dude from Gerber who signed this thing, this president of Gerber, whoever this charlatan is who's stealing out everybody's money, Keith M. O'Reilly. Anytime you want to go debate whether or not Gerber Life Insurance is a good product for any of the people having it, come on with it, bro. Any day, anytime, anywhere. This is ludicrous. This is taking people who think they're doing something good for a child, who don't understand finance, and selling them a product that they don't need, they don't want, and that it's a terrible financial investment for them. And I'm going to show you all of that. And that's why this kind of shit pisses me off, because there's no way that anybody needs this. And all of the things that they're promising in here, oh, grows like a nest egg. Grows like a nest egg that belongs to somebody else, or you're giving them all the freaking money. That's the nest egg that it grows like. What a crock of crap. And I'm going to show you the math on that. And this is why this kind of stuff pisses me off. So if you know anybody that's got one of these Gerber Life Insurance policies, please send them this podcast so they can realize they need to cancel that. Stop making that payment. Start putting that money into an investment account for that child. Because if it grows at the same rate that Gerber's saying it needs to, 8% here, then this is the worst investment you could ever make for your child, not the best one. Oh, permanent life insurance coverage. You don't want that. Permanently, somebody gets paid if you die. Who wants that? Nobody needs that. You're talking about children. Nobody needs money if a child dies. Okay? Now you're going to argue, oh, well, the parents get some money so they could pay for a funeral or pay for something else. Well, why don't you be upfront about that and say that that's what it's for? Because that's not what you're saying here. Oh, yeah, by the way, only as long as the premiums are paid, right? We're going to get into that, into the real dirty little details of this letter, of all these important things, except for when you go read down here and start reading fine print. Policy loan interest rates 8%. As long as original payment method does not change, your policy, your payment doesn't change. Oh, so if I change my payment method, all of a sudden my premium goes up? Explain how that makes any sense to me, Gerber. These guys are crooks, right? And they highlighted all of this. This is the hilarious thing. And I'm going to go through each one of these things because they all make me angry. They all make me very, very angry because they're highlighting these things. You're about to do something wonderful for your child or grandchild. The something wonderful is you get a check if they die. How wonderful is that? Oh my goodness, this makes me angry. If you send me this for my niece or nephew and you say, oh, do something wonderful for your niece or nephew, get money if they die. That's not doing something wonderful for them. That's doing something terrible for them and good for you if they die, which is a horrible, horrible thing to do. Oh, this makes me angry. All right, let's go through the pieces of this. Their fear and manipulation tactics that Gerber pushes out on people who financially don't know what they're doing. And then I'm going to tell you about how much Gerber's worth because it just got sold to some company by, the great crooks of the world, Nestle, who really care about you, who also, by the way, now own the Gerber product line. So I wouldn't feed that to anybody that I know because you cannot trust Nestle to do anything. And if you think I'm wrong about that, go look at all the documentaries on Nestle and water and how they're stealing our water to sell it back to us at a ridiculous price. Nestle is one of the worst companies in the world when it comes to doing right by people. They're the ones poisoning people with very cheap food, and now they're starting a section of Nestle that's supposed to fix people after they poison them. Oh, thanks again. Get the hell out of our water system. Get the hell out of America, Nestle. Swiss company that does nothing but poison the world. All right. So, first, we're pretending it's good for a child. Okay, no one needs insurance on their children. I just went over the whole entire purpose of life insurance. It's to protect your children if you die. You don't need insurance on your children if they die. You're not dependent upon them. It's the other way around. So, twisting this around as though it's some great thing for children to be insured in case they die. Literally, your children are worth more dead than alive to you. Oh, that's a great thing you want to invest in. Oh, that's pretending it's good for the child, right? No one needs insurance on their children, okay? Now, they also go into this and they pretend that, oh, hey, if there's a whole life piece attached to this. Oh, this is a great little thing that they hear, Oh, it builds cash value over time. And in their own documents, and I guarantee these amounts are tiny because they don't publish what they actually are, right? So they're saying this is whole life, which means there's a little bit left over, right? But as it turns out, that amount left over is going to be A, tiny, right? And B, if you just put that money away, it would be way, way more, right? Here's the piece that you want to see. The beneficiary. This is what I'm talking about. This is nonsense. You are the beneficiary, i.e. you get paid if your kid dies. If they were being honest about this, that's what they would tell you, And this idea that there's some cash policy available for a kid when they're 18, I'm going to show you the math. If you want to leave your kids money, just start putting an account for them right now. Then you'll leave them something when they're 18, not some bullshit product from Gerber where they're taking most of the profits and pretending that they're doing you a favor. All right, number 2. They're selling the fear of the future ability to get insurance, okay? So if we look at the highlighted sections here, that is coming up later. Too many things in PDF that I'm sharing right now. Okay, so we're going to go to their highlighted sections because these are the things that make me the most angry. And since they highlighted themselves, let's take a look at these. And I think, let me pull this up real quick. This is very interesting. Okay. Here we go. guarantees your child will be able to get more insurance later. All right. This implies that most people are not eligible for life insurance later. All right. Now, first of all, if you read the fine print on this, it does not guarantee that they're going to be able to get a massive, massive policy, right? It guarantees 10x. Well, 10x of their maximum, right? Realize their maximum down here on their charts here is $35,000 of life insurance. Okay, so they're saying it guarantees you can buy 10x, right? At a ridiculous premium, because as you're going to see, these premiums are already absolutely ridiculous, right? So even if they double that to 70,000, you're going to see why, even if you make all those premiums for average life expectancy, it's a absolute Ponzi scheme. This is totally crooked. It should be completely illegal. And the Consumer Protection Financial Bureau should go after these crooks and shut this down because they're stealing money from American families. That's nothing else is happening here except for that. But the point is, this is what they highlight. You're not going to be able to buy coverage later. So they fear you with that. Well, guess what? Almost everybody can buy coverage later. Okay? So even if you're one of the few who can't buy coverage later, guess what? You still can. Okay? So this is from Policy Genius, and Policy Genius has this document. So what do you do when you don't qualify for as much life insurance as you'd like? I.e., exactly what Gerber's selling you the fear that, oh, you're guaranteed now your child, even if they grow up and something's wrong, they'll still be able to buy a lot of life insurance. Well, guess what? You can anyway, right? So Gerber's pretending that they're giving you something that you won't be able to get otherwise, but the reality is just like with all this BS marketing crap, you can, right? They just don't want you to know that because they're feeding on people's ignorance, okay? So know that you can go to Policy Genius and buy guaranteed life insurance. It's a requirement, okay? And apparently Alex Trebek is out doing commercials. I haven't seen these because I try and avoid commercials like the plague, but, there is guaranteed life insurance, okay? And the reality is for most life insurance policies, until you go over 250,000, most of them don't even require hardly anything happen. They'll just issue the policy immediately. And sometimes they'll require a blood draw. Sometimes they'll kick certain people out of certain things. But if you're young and the age of which you would have dependents and need insurance, almost everybody can get it. Okay? So, and if you can't, then there's always some limited portion where at least you can cover your family with some life insurance. So this shows that Gerber's claims are absolute nonsense. All right, let's go to the next of these nonsensical claims. Why would the amount of premium change when your payment method changes? Oh, yes. So when we read into the Gerber fine print, here is what we find. Okay. The coverage, the premiums you pay now will still be the same. The premium is locked in for life. Now remember, I did not highlight any of these things in yellow. This is how the letter came. Okay? In fact, here it is. They highlighted these things, not me. All right? They're the ones that highlighted this crap. So when I'm going to sit here and debunk it, I'm going to debunk the things that they highlighted themselves. So they highlight the premium is locked in for life. But we notice a little subscript here. 2. Oh, so let's go down to the fine print. What does number 2 say? Number 2 says, as long as the original payment method does not change. So let me tell you what that means in their bullshit legal speak. This means that if you change the payment method, i.e. which bank account the payment comes from, not make your payment, just change the bank account that your payment comes from, then Gerber has the right to change your rates. And guess what? You think they're going to lower those rates when you change your payment? No, of course they're not. They're going to raise the rate because these guys are already vultures. Right? You don't send this stuff out to people, this is a great lesson. The lesson of this Gerber letter is, and everybody needs to know this across the board, it's with everything. Deals do not show up on your doorstep. Good deals are hard to find. This is not a great deal for families. That's why they sell it to you with so much lies. So much lies, right? Oh, we're guaranteeing coverage for life. $35,000 of coverage? Oh, it's going to double to 70. Oh, we guarantee that when your child turns 21, they can go 10x. Yeah, and they probably have to exercise that option right at 21. When they have no dependents, they have no need to make these huge premium payments, and they can't afford them. So the odds that that's going to actually happen are so small, and they know this. This is why this is so predatory. This is why it makes me so angry, right? Oh, your coverage starts at pennies a day. Pennies a day you could be paying for your family, you know? Oh, and it's not actually just a couple of pennies. It's, the lowest, a $10,000 policy on a 3-year-old healthy child for only 25 cents a day. Oh, great. Misleading, 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 misleading. If it wasn't misleading, they wouldn't have all this tiny script below, you know? And then the fact that they go, save 10% is easy with our automatic payment plans so we can lock you in, you know? Oh, and when your child turns 18, the coverage amount doubles. Great. Now, who has to keep making the payment? Because if they say that this transfers to the child at 21, so that means who's responsible for the payments then? And, so if the payment then has to come from the child, then the bank account has to change, and then we can change the rate. Oh, all of the dirty little tricks that they're going to pull out in here. All of this. If it's all out front, if this was really good for families, they would be very honest about all of these things. And by the way, you're still getting paid if your child dies. Terrible, terrible product. Then we get down to the certificate, which is the part that pissed me off to begin with. Again, you're inferring that this certificate gives me some privilege I wouldn't other have. Oh, I have a certificate that allows me to apply. These guys, I must have done something great. There must be other people who can apply. No, it's nonsense. No one needs a certificate to apply for any life insurance. Everyone can tell them. Why are we not telling people that they're going to get a check if their child dies? The reason is because you wouldn't sell any policies. So people think they're protecting their child in some way. If you're going to buy life insurance when a child is born, you don't buy it on the child, you buy it on the parent. The child's dependent upon the parent, not the other way around. They've got this thing completely twisted backwards, and because people don't understand what they're buying, they don't understand how this product's going to work, they're manipulating people out of their money. Shame, shame, shame. And the guy who signed this thing, who's the president of this company, I guarantee you he didn't have a policy on his own kid under this program. He's not going to spend his own money, just like I would bet you that the heads of Nestle don't feed their own children the Gerber baby products that they're now making. Why? Because it's not healthy. Keith M. O'Reilly, shame on you. You should be shamed for running this company. You should be shamed of manipulating these parents. And you think this isn't that big a deal, right? Oh, except for, guess what? Western Southern, who is now the financial group that owns this thing, paid Nestle $1.55 billion just for this Gerber Life Insurance name and logo. And the intellectual property. The intellectual property probably includes this letter, right? Oh, we've got this great form that's our intellectual property where we send it out with manipulative total manipulative speak. This is all nonsense. This kind of shit makes me so damn angry because people don't understand it. Valuable product offerings. There is no such thing as a valuable product that pays when a child dies. Okay, that's not a valuable product. Okay, when the product needs to be when a dependent dies, that's not the product we need. We need the product for the dependent. This is terrible. Yeah. They're very thrilled to have this because it's extremely profitable. And that's the next piece that I'm going to show, right? And they tell us how many people that they've suckered out of this thing. It's 30, Gerber Life's $52 billion of life insurance in force, 3.6 million individual life policies. Okay, so they've convinced 3.6 million people to buy this crap on their children. Most of these policies will expire, and if they don't, let's just assume that A, you bought a policy for your child. They lived to average life expectancy of 70, and then it pays out. Oh, and it's going to pay out double. So I have to remember that, and I'll have to change this here at the bottom. But okay, so here's what we do. You buy the policy when the child is less than 1. So it's going to cost $21.98 per month. That's per their letter on this is the rates. Oops, sorry, this is average life expectancy. Oh yeah, average life expectancy is 75 years old. Okay, that's a piece we needed to know. That's from the Social Security Administration, not from me. I'm not an actuary. I just pulled the data from everybody. So, Social Security Administration says, on average, you're going to live to 75. All right? Now, Gerber's policy rates are, we'll take the highest life insurance policy, $21.98 per month. Right? So, now we take that into our worksheet. We $21.98 per month times 12 months. So, $264. Now, we're going to infer that we're going to get a 8% return. So we get an 8% return on the money from the year before, plus we add in another $264 because every year we're paying in $264. So this is a pretty easy calculation. And I'm just showing it year by year. So this is what happens every year. The amount that's in there we make 8% on, plus $264 more dollars. Okay, so if you live to be 70 and you make all of the payments, the rates never rise, right? And I need to change this. The family, instead of getting 35, I forgot. The coverage doubles. What a great deal for everybody with the doubling of coverage at age 21. So now it's $70,000. Instead of, if you'd have just taken that money and invested it, your family would have $700,000. But Gerber, and the great product of doing something for your kid is going to give the family 70. Shame, shame, shame. So do your kid a favor, right? Because here's the thing. If you want to invest in your child's future, if you want there to be something for your child or grandchild when they're 18, then start putting away money for them. And by the time they're 18, you'll have $10,000 in that account. I guarantee you, the whole life insurance value of that policy that maxes out at even at $70,000 is probably a tenth of this amount. And your child's odds of dying are so infinitesimally small. Tiny. Add all of them up and you're not going to have 1%. So, and your child does not need life insurance. This is why Gerber is manipulative, right? And if you actually take this to term, right? So the idea that you're going to make all of these premiums and that at the end when you finally die, because this is the other way people use life insurance, and they go, okay, well, I'd like to leave my family a big chunk of money. I don't have a big chunk of money, so I'm going to buy life insurance. I'm going to make those premiums, and then when I die, my family's going to get this big chunk of money. In the meantime, the insurance company invests it every year, right? On any other policy, there's no way these amounts would be 10x. This is because you're literally stealing from families. And you've convinced 3.1, 3.5 million families to sign up for these bogus policies that pay out, at best, 10% of the money the insurance company's going to make. Of course, this is why this business is worth $1.5 billion, is because this is how much money they're making. They're making tons of money on every single family. It's crazy. So don't do it. Don't give them your money. Don't buy life insurance on children. Don't do it. And if you want to see the worksheets, you want to see all the info, it's all in the show notes. Sarah will put it all up. Thank you, Sarah. Please don't do this. So the math tells the story, right? I got to change this. Instead of 35, X that out, you get 70. Instead of 5%, you get 10% of what you would if you'd just kept your own money. You don't need any of this. Don't sign up for this. Horrible, 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 horrible program. Consumer Financial Protection Bureau should be shutting these programs down. This is stealing money from families. I don't see any other way about it. Anyone wants to come debate me on it, tell me where to show up. We can have this debate. The data tells the story. I'm surprised this isn't reported constantly to let families know. So please help us share the message. Help us protect people's money. Help you keep yours. Help your family keep theirs. Right? Help us spread the message. So do the likes on Instagram and Facebook, and give us ratings and review on YouTube. However you're consuming this, please pass it along to those you need. This is all free info, so we can actually help people get educated so they understand these systems, understand how they're being manipulated by bad companies like Gerber. We need to get this word out. So please help us do that. Thanks for listening. Catch you next time. Have a good weekend.